Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, April 26, 2022. What I wanted to do is a brief update on the equity markets and anything else that stands out here. But right now we're seeing a lot of movement in the equity markets, and it's a popular trade. It's easy to trade. There's a gazillion derivatives out there: ETFs, leverage, non-leverage, inverse, futures, and with tons of liquidity as well. So. And also the added benefit right now, it's earnings season. So let's just say, for example, you want to, you're betting that the FANGs are going to fall, but you want to short one or two, and those one or two happen to go, let's say it's Apple or Amazon or whatever, and they go against you, you can get hurt really bad. Those stocks, as big as they are, largest in the world, market cap wise, they still, I've seen them easily go up and down 10% in a day and gap up or down that much. And so with the indexes, especially stock futures, my preference because they trade around the clock, I can manage my stops. If at 3 in the morning there's a huge rip in the futures, up or down, something goes on, global event, or even after hours, then you're covered. They do shut down at the end of the day, so we have earnings season, so there is that little brief shutdown period that it can move. But let me just get to the charts real quick. Trade what you're comfortable with, of course, and if you don't know futures, read up on them, learn. The QQQ, there's that bear flag yesterday. Yesterday was extremely frustrating. I had gotten that video out plenty of time and started recording at 2 o'clock. Internet crashed, which crashed the whole, was during the upload process. That resets that whole, moving from my PC up to YouTube. Have to re-render the video and then try that several times. I do have backup, which is cell phone to tether, but my signal is not nearly the upload speed, especially on those high def videos, and a longer one like yesterday. And then there were a few crashes there trying to get that up. So believe it or not, that video I started at 2 o'clock. I finally got out to you, I think after 6, the whole time trying to get it to you guys. So sorry I couldn't get it out before the close. Again, technical issues really beyond my control there. But it wouldn't have mattered. What I wanted to point out, and I did in the video, and I pointed out today, is there was no trigger on those bear flags. That's one of the most important things. We had the impulsive move down, i.e. flagpole, followed by a level of consolidation on declining volume, i.e. that is a bear flag continuation pattern, and today we broke down. I'm doing the video now because I try to make my thoughts as clear as possible and also speak to active traders versus trend and swing traders. Trend, swing traders, I'll be clear. I give you the measured target earlier in that post. It's over all the way down here. That's simply take a line. The easiest way is just draw a trend line, take the distance to the flagpole, the whole move down to the bottom of the flag, add it to the top of the flag, and that gives you your measured target. So that's roughly 306, as I showed you earlier. But and I do think we'll get there. I just don't think we're going to get there in typical bear flag fashion. We may, which means typically the way the flag plays out, you have a nearly equal. The measured target's the same length, and it's usually just as impulsive. What I call a unidirectional move. I mean, this is here's a trend, a downtrend, but it wasn't unidirectional. You had kickback rallies along the way. This you can see all red candles going down. So. And look, it is possible. And again, if you're a swing trend trader, it doesn't matter. The little squiggles don't matter. If you're a very active trader, you want to gain some rips and dips, I'll show you levels. But I think we're getting there. It's just a matter of how we're going to get there. And again, the big thing is the FANGs that are reporting this week. Huge earnings. Microsoft, Alphabet after the close today, followed by Facebook, PayPal, Qualcomm tomorrow, Thursday, Amazon, Apple, Intel. So we already know, so far my theory is panning out that we're seeing the rut row. And again, I don't get these maybe I can try to understand putting myself in their shoes, fund managers, individuals, waiting to the last second. Just like we saw right up to the FOMC meeting. You knew rates were going to be hiked at the last meeting, and then you wait and see that last minute selling. You knew the FANGs were going to report, but I think what changed it for them, if I try to put myself in their shoes, is they didn't expect Netflix to have get annihilated after earnings for the second time in a row. We saw it with Facebook. So again, I think that's just prudent profit taking on a lot of investors and fund managers' parts, not wanting to be caught on the wrong side of a disappointment from any of those big market leading stocks I just mentioned. However, with that being said, 3% is usually about the limit unless there's any big news in the market. 3% is about it for the day. So here we are. We're coming up on, this is why I want to do the video. We're coming up to those recent lows right there. Major double bottom low in the Nasdaq 100 from late February and mid-March right there. So that's support. A lot of eyes will be on that. I gave you my thoughts way before we even got there. Even on the bounce up here, I started scaling back short, mentioned all the way up to this point here, and told you that I suspect if and when we get there, there's going to be little to no reaction. We may go through there, and look, that may still happen. Maybe they're selling leading right up into the close today. Profit taken on those big fangs. Plus, then they do come out, and whatever they say, again, it does not matter how bullish or bearish their actual earnings are compared to forecast and expectations, as well as the guidance. It's the only thing that matters is the market's reaction to it. So where I'm going is we could play out in typical bear flag fashion where we just do this. And that would also mesh with what I've been saying for a long time now, that even when we did all this, that I thought we'd come back down and take out those lows, and B, I thought when we got close, we would probably just blow right on through there with very little to no reaction. So, I said that back here. There was no way to know that we'd be here right now, right in front of those big earnings reports. So that's where, again, it may foil up how we get there. Though, all I'm doing is speaking to the minor squiggles and zigs and zags on the way down. Again, I'll reiterate. I think my weekly targets are still going to be hit once we solidly take out those recent lows, which we're almost to right now. Those two previous lows, that should open the door to my second target, which in turn, again, this is how it works. It's all related. Will then continue to, or has the potential to trigger some even more powerful long-term sell signals, such as, for example, one of my favorite, covered this many times over the years, the 20-month exponential moving average on QQQ or SPY does, and again, I rank it a 10, an absolute 10 for indicators when factoring in both reliability as well as simplicity. I mean, there's nothing more simple than using a single moving average to define a trend. And this is long-term trend. This is bull bear market stuff. So I've covered it 100 times. And, when you're below it, bottom line, especially a solid monthly candle like the bear market back here. You broke it back in the first leg down on the bear market, 07, 09. Tried to recover it. Had 1 month where you did and then failed the next month, stayed below it. You can see that. I don't know if you can see it in the video. Same with the 2000 dot-com bubble, big bear market, 84% drop in the Qs. And once you took it out, there was your takeout candle right there, a solid red close. And so even if you waited, even if you're not an active trader, you tend to err to the bullish side, which is what over time you're going to make more money being a bull more than bear. Bears make a ton of money, but you have to be nimble, in and out, don't stay too late to the party kind of thing, because when the move's over, the reversal's pretty explosive. But stocks tend to fall a lot faster than they rise, and that's why I'm a flexible trader. I'll go long, short, and again, even if you waited till that monthly candle, I'm going to pick the very bottom where we closed the month. You had a solid sell signal there back in November 2000. So had you shorted or got out of your 401k, you either made 70% into the lows or averted a 70% loss. If you did it back here in 2008, well, you had the candle was taken out there. So let's say you took that signal. You could do either one. You could do this one. We'll just take that signal because that was the first time we had a monthly close below it, and just say you held on because the charts, I can tell you at the time, that was a bear market rally. I remember trading it, reversing, being long, and then got short again for the next leg down. So that would have been the signal to take. And so even though you wouldn't have got all of the 55% drop, you would have got 45% of it. Again, just shorting the break of that 20 months. So that's where I'm at, guys. I didn't want to ramble and go back, but this is big picture stuff. And right now, today is April 26th. Here's where we're at. We're flirting with those lows. All the big fangs are on deck this week. After that, I don't. There's really not, unless something crazy goes on over in Ukraine with Russia, that situation, or somewhere else in the world. We know what the Fed's going to do. We know we're getting 50 basis points at the next meeting, so there's really no surprises there. And the big fangs are all going to have reported by Thursday after the close. So pretty much, unless they come out and just whatever they do, they blow it out of the water. Everybody loves what Amazon, Microsoft, Apple, etc. are selling. That has the potential to close us back above there. If not, we're going to have the first close right here, monthly close on the 200 on the 20-month monthly moving average since back in 2018, and there was that was the one of the biggest drops, 24% drop. Look, it was over before we knew it. Didn't prove to put us onto the next bear market, but then you had a recovery next month you could have got out of. Again, you could just simply trade off this, and if you do the math, you would have caught 90+% or close to it of all the bull markets in the last several decades, and also captured a good part of the bear markets by just using these monthly closes. So that's why I wanted to harp on this, because again, it's not my only indicator long term. It's just one that works very well and kind of shows big picture. But back to where we were. So I think we're going to bounce. I told you 3% is about the usually the limit for the day. So if you're an active trader, you can see here on the 60-minute chart, you get a little bit of divergence on the 60, but I like trading the 5-minute chart as well. You have the PPO curling up here. Let me throw up a histogram, show you what I look at. And you get these deep sell-offs when the histogram goes. You get a bullish crossover, what I call low level. Not all these in-between crossovers there. When you have that clear big drop, you get a bullish crossover, that tends to pop up. So I think we pop up. I've got a chart for you on NQ, or at least one that I'm trading here. So just before the video, I reversed it, and I think we're going to pop up at minimum to 13,230. I understand by the time this video comes out, we probably hit that. And I've always said this. I can't. For day trading, all I can show you is, how I trade, what I'm doing. There's no follow me in day trading. It's like trying to follow Tom Brady on the field during a game, mirroring his every move to try to learn how to be a quarterback. You can't do it. This is just too fast. I'm in and out. By the time this video comes out, if I'm correct, we'll have at least hit that. And I think this is my max bounce target. You got a downtrend line on the 5-minute chart right here in price resistance. So this is probably where they'll buy it up to today, at very least right here. And again, 5-minute PPO crossover just occurred here. Pretty steeply oversold near term, and you're down 3%, or we're just a minute ago when I started the video for the day, without the fangs even reporting yet. So that's it. So, and that all comes back to how this flag, that's, I know I'm going all over the place here, but how this flag's likely to play out. Again, I don't think you'll see all red candles. What you're probably going to see is some green candles along the way, and some gaps. I'll tell you that right now. So if you are risk adverse, I know that's an oxymoron for a trader, even a swing trader. If you're an investor and you're risk adverse, you're going to have a lot more bonds and blue chip stocks than you will tech stocks and crypto and other stuff. But again, I'm speaking relatively speaking. Some traders are more aggressive than others. So what I'm getting at is expect over the next week or so some volatility as these things come out and report. And, we may zig and zag our way down. And if you're not an active trader, just keep your eye on the price. If you happen to agree with me where we're headed, I've given you my targets 100 times over the last few months since we were back here. These targets were laid out well in advance, and that's the next one, down 299 to 300, with the potential to blast pretty quickly through there and head on down to the second or third target here, about 268.30, and or the trend line. See, trend lines are dynamic. They come in at higher and higher levels every day, so those two will probably come in together. And then I have this alternative or lower trend line with my max target T4 down around 235. That'd be a 42% drop from the highs, and that's also it's what I call the pre-COVID lows, is kind of where I'm targeting right now before I start to roll into really start looking to reverse in long-term accounts, trend trading into long positions. It depends on if and as we even get there, and then how the charts look. So remember, we may get coming, be heading on down there, and I may add additional targets, or we may be heading on down there and I may cover early. It all depends on how the charts look at the time. Price, volume, divergences, what the market leading stocks are doing. Are they coming up to support, or do they just break long-term support, et cetera, et cetera, et cetera. All right, that's it. Same old things. I'm still overweight. I've been overweighting since the market peaked back last year in both. Remember the stock market, quote unquote, didn't peak back in November. Being the S&P 500, if that's your gauge, it's a more diversified metric. That peaked back in the end of December. But everything that I've shorted, I've been short index-wise, which is the Nasdaq 100 and small caps. They peaked back in November, and so that's what I'm referring to there. And those guys are still look to be headed lower, and that's still where I'm overweighting. This is the IWM. The last what I call golden short is right here. We've had several opportunities to short. If you missed the breakdown there, if you caught it, hit the first target. If you covered, if you're an active trader, we've had multiple shorting ops here on the push back to that key 209 resistance level. And again, I just want to do this update because everything's back down. We're back down to the bottom of these ranges. So remember a few weeks back here, I had what I call, market, whatever you want to call it. I hate to use the word crash alert. Sounds so dramatic. But, I use warnings versus watch. Just like a tornado or a hurricane, a warning is more severe, indicates that the conditions are ripe. Doesn't guarantee you're going to get a hurricane or tornado, but it means the odds are much higher than in a watch. And so right now we are back on a crash. I'll call it, for lack of a better word, a crash warning, because we're right there. A couple weeks ago I told you we weren't. I pulled that off and we went back to a watch, right? Because we were well below those, well above the recent lows. So there it is, IWM, QQQ. And there's, to put the line there, those are the double bottom lows recently. And then, of course, we're finally seeing the other sectors. SPY has been a nice holdout because it's full of steady Eddie dividend-paying stocks and chock full of defensive issues, which the tech-heavy, high-growth Nasdaq 100 is lacking. But now we've seen a lot of those staples, discretionary, all these other stocks breaking down in the S&P 500. And just like those other two that I just showed you, the Nasdaq 100 and the Russell 2000 small cap index, the SPY is also coming up on those that recent low right there. Big level. You had all this support back here earlier in 2021. Came and checked at 1, 2, 3 weekly candles. And that really helped to firm up that support. So there it is. It's about 415.51. Bulls want to see this, and if they get it, great. They need to defend that level. If not, they take it out. We're going to hit my second target on SPY most likely, about 394.50. And remember, those are just near-term targets. My longer-term targets, I've gave you a few months back. 354, 339, and then 324. That would also, if hit, take you down around what I call the pre-COVID lows right there. A bunch of reactions. So this is really the target range right here. All those reactions. That trading range. We had that mid-level consolidation in the post nuclear response from the Fed and the not just the Fed, DC as well. Overstimulation, and they're taking the heroin away from the patient now. So as aggressive as those targets might seem to some, I've mentioned this many times over, all it would do is take us back to our primary bull market uptrend lines in QQQ. So calling for a 44% drop, especially months ago when we were right off highs, I know it was heresy, especially among a lot of analysts and people out there, but to me, it's just a run-of-the-mill, not run-of-the-mill. It's going to be a big one because we got so far ahead. It's just a mean reversion coming back, and that could still keep the Nasdaq 100 in a secular bull market if we pulled back to that level and held it. Now, we break that, and that's something ugly, or something uglier might be going on. But again, let's cross that bridge and we'll get to it. We're not even halfway there yet. What are we from? Calling for that 44% max drop, or 42, I'm sorry. And so far we fell 20. Yeah, we're halfway there. We're exactly halfway there. We've dropped 22%, and I measured that being, or 21. I measured that to be about 42% off the highs if and when we get to my final target. So there's that. Let's wrap it up here on the indexes, because if I start going into crude oil, natural gas, bonds, well, this video will go too long, so I'm going to keep this one short, and a little shell shocked after that snafu trying to get that other one out to you yesterday, so I'm going to cap this one here at 20 minutes, get it out to you. And again, just to reiterate, I do believe we're going lower. I do, these bear flags that broke out looked pretty legit. By the way, that's what you want to see. You want to see an impulsive breakdown. That's what you got. Check. Red candle. Follow up impulsive candle. Check. And so that's it. That's all I'm saying. For near term, we'll probably go into a holding pattern hole here around 3%, give or take. You're not going to see 5% or lock limit down futures. It is possible. Anything's possible. But I think we'll see some shorts, nervous shorts taking profits before the close today. And the rest of those that haven't been shaken out of the big fangs yet, holding. And then anything goes tomorrow. I'll address it. If there's a big movement overnight, and there'll probably be almost certainly some movement in the futures, I'll update if there's anything significant. But again, I do these videos to get the levels out to you in advance, so you can replicate these on your chart or see if they match with what you're seeing. And if not, drop a line in the comments section. I love feedback, especially that doesn't agree with my own analysis. I'm prone to miss things like anybody else. And if there's something I'm not covering and you think I should, just drop a line in the comments section below this post or any post. All right, guys, I am going to end it here. You have my near-term bounce targets for active traders, potential bounce targets, and then also for those less active traders, don't get cute. Try to game the bounces if that's not your wheelhouse. If you're not used to doing that in a volatile market like this, you'll get chopped to bits. Just like I said, sit tight and hold out for the prize. Prize being the next target or targets, depending on what you're looking at there. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.